Have you ever wondered about important keys for smart investing? Today, we will look at essential strategies, from finding the perfect time to buy or sell to discovering great opportunities. Stay with us to improve your investment skills. Things are about to get interesting. Focus on long-term economics. Build lasting wealth through a focus on long-term economics in investing. Avoid the pitfalls of short-term thinking that often lead to limited wealth accumulation, a lack of compounded growth, and even worse, investment losses. Learn how to leverage undervalued opportunities for sustained wealth creation. Analyze a company's fundamentals for true long-term value. Seize buying opportunities during market downturns, capitalizing on solid fundamentals and strong management for future wealth growth. Embrace bad news as a chance to invest wisely in a company's enduring success. Understand your investment. Stocks. Investing in a company means partial ownership, potentially yielding dividends. Stock value appreciation depends on the business's performance. Bonds. Buying bonds is like an IOU from the company, with interest payments contingent on its success. Poor performance may lead to default. Due diligence. Ensure a solid return by understanding your investment. Avoid investing based on optimism or media hype. Look into a company's fundamentals, how it makes money, manages funds, and benefits users. Research matters. Past performance doesn't predict the future, but understanding a business is crucial. Limit investments to companies within your financial and intellectual understanding. Be prepared for economic and business cycles, knowing that a solid understanding of operations builds confidence for long-term success. As Warren Buffett consistently emphasizes, look for competitive advantage, understand the business, grasp how it earns, manages finances, and the effectiveness of management, etc. Competitive assessment. Evaluate market share, performance against competitors, and product differentiators. Durable advantage. Seek a unique market position, be it a leading brand, unique service, or economies of scale. Pricing flexibility. A company with a durable advantage can raise prices without losing market share, ensuring long-term economic growth. Investment rule. When considering a company, ensure it has a durable competitive advantage, key for long-term shareholder value. Look for resilience in the face of market challenges. Consistent operating history. Again, past performance is certainly no predictor of future performance. But, in my experience, the best returns are achieved by companies that have been producing the same product or service for several years. They have a proven track record. New products and new companies can also prove worthwhile investments, but they're more speculative since much remains unproven. A company undergoing major business changes also increases the likelihood of committing major business errors. A steady track record is a relatively reliable track record. When a company has presented consistent results with the same type of products or services year after year, it is not unreasonable to assume that those results will continue. Effective management. Management quality. Assess managers' rational allocation of capital, crucial for long-term shareholder value. Transparent reporting. Look for honest reporting of financial performance, acknowledging failures and rewarding shareholders for successes. Independence. Beware of management following the crowd, leading to misallocation of capital. Evaluate actions and words through annual reports and media. Quantitative analysis. Assess effectiveness through ratios like ROA, ROE, and ROIC. Compare with industry competitors and analyze trends over time. Operating metrics like inventory turnover offer valuable insights. Smart investment starts with effective management. Buy at attractive prices. Timing matters. Be cautious of investing at market highs. In a seller's market, paying top price may minimize returns. Margin of safety. Follow Benjamin Graham's strategy. Buy during market lows or when a stock is below intrinsic value. This ensures a safety cushion in your purchase, presenting opportunities during recessions or economic hardships. Discount opportunities. Look for underpriced investments during market short-sightedness. Buying at a discount, especially during economic downturns, can yield above-average returns. Seize opportunities when the market underestimates future earnings value. Conclusion. These are core investing principles that have allowed me great success. Having core investing principles upon which to stand will afford a strong investment strategy with impenetrable focus. The market will always generate a lot of information, misinformation, and speculation around investment opportunities. But having core investing principles will allow an unwavering approach to investing. Additionally, if such principles have stood the test of time with other successful investors, such as Warren Buffett and Phil Fisher, then the likelihood is they'll stand to benefit you as well. If you found this information valuable, don't forget to like, share, and subscribe for more insightful content on making informed financial decisions. Raise your investor IQ with cutting-edge info, insight, and analysis. Visit and subscribe for free at the link below.